Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This is one that actually from something that Steve and I we did an event around the beginning of the year up in Canada. This is the Canadian loonie, and I want to show a comparison. This is the Canadian dollar versus the U.S. dollar. So we can see in here the Canadian dollar has been very strong as the U.S. dollar has been weak, and then we can see the U.S. dollar strengthening. This is the comparison that I want to show, and this is against GM. Steve can tell you we were actually at the same event, and I remember us talking, and this is actually what gave me the inspiration for this comparison. Up in Canada, everyone was very, how can I put it, arrogant about the Canadian currency. We were told how our U.S. dollar really isn't worth much. I remember one of the promotions that Steve gives away at the booth was actually U.S. dollar bills, just to kind of do a little promotional thing on the ISE options product. And I remember some of the jokes that we were hearing about our currency back when we were up in Canada. There was actually a commercial on TV that was running the entire time that we were up there based on how strong the Canadian currency was, and everyone was supposed to go out and buy a Cadillac. Buy a Cadillac now based on the strength of the Canadian currency. Now's the time to do it. Well, let's take a look at this. Let's see how GM fared during that time frame. This was around January of last year. And does this mean that the fact that the Canadian dollar is what kept GM up during that time? No, I'm not trying to say that. But what I do think is interesting is the fact that GM was actually around $42 in this time frame that I'm pointing to here in October of last year. And this is when the market was at its high point. But look at what the Canadian dollar was. We're a little bit lower here. Or, I'm sorry, the U.S. dollar versus the Canadian dollar. But as time goes by, around the time of January, this is about when the U.S. dollar and the Canadian loonie were on par for the most part. Now, it's pretty much a dollar and a loonie were about the same thing. But we can see in here how the loonie goes up a little bit. Now, does that mean that the fact that the U.S. dollar strengthening is what's giving GM all their problems now? No. They have a long list of problems that is far beyond the scope of tonight's webinar. But what I do want to point out is the fact that GM didn't look this bad a year ago based on the stock price. And the U.S. dollar was not that strong a year ago, or was a lot weaker a year ago. And GM, if you look at the fundamentals of General Motors, was actually doing pretty decent overseas, and they're still actually doing okay overseas for the most part. Well, within the last few weeks, I'm not going to comment on that. But if you were to watch that CNBC special, Saving GM, overseas they're not doing too bad. But what could be something to think about is the fact that with everything that's going on right now, could the weak dollar have been something as to what was holding GM up all that time? I don't know. Once again, that needs to be your decision as a trader. But the point is this, is that currencies are something that you definitely need to take a look at and have some at least thought to, whether you're a long-term investor or a short-term trader, either or. Now let's look at another one. We've looked at some stocks, and we've talked about oil a little bit, but what I want to show right now is a comparison of, let's get back to the U.S. dollar versus the euro. Let's talk about a comparison. We're just going to go over the course of the last 3 months. I want to show this versus the 10-year note. Now this is a futures contract that I'm just kind of showing to just show for the purpose of comparison right now. TYZ8. Let me get this up down here. I had to change accounts before we got started, so we had to make a few adjustments on this before we started, so I apologize for the delay on this. There we go. TYZ8 is the December 10-year note futures contract, and what I want to show with this, we have the the EUI contract increasing, but not as much as what the 10-year note is. But this is what I want to point out. Around this time, I believe it was I believe the Sunday night, the last Sunday night, I think September 28th, I think was the exact date, that Lehman made their announcement. And we can see when Lehman made their announcement on that Sunday night, we can see what happened to the U.S. dollar. There's a lot of flight into the U.S. dollar. At this point in time, we actually also had some flight into the 10-year note. Now, this movement right here does not look like a lot. For those of you that have ever traded the 10-year note from here to here, so to speak, that's a lot of movement in the 10-year note. Now, of course, right here, the U.S. dollar continued to strengthen. We had a little bit of a pullback in the 10-year note. One thing that we're not able to show is before this, we actually had quite a big run-up on the 10-year note. So we had a little bit of a pullback on the 10-year note, but what's continuing to happen is we are having a bull market in the treasuries as well as the U.S. dollar. So in terms of correlation, right now, of course, the theory is that everyone's taking a flight to safety. A little bit, what's an interesting statistic is that we are actually on the shorter term treasuries, like for example the 1 month and the 3 month, we're at like 0.01%. We're actually approaching almost a negative rate of return on those treasuries. Now of course the first thought is, well, that could never happen. Of course this is as low as they're going to get. An interesting fact that I dug up when I was preparing for this presentation, during the Great Depression, U.S. Treasury bills actually had a negative rate of return. People continued to buy them. I was not aware of this. This was something to where when I was doing a lot of research for this presentation, I learned that, and the rationale for that was that people felt it was safer to be in the U.S. Treasuries and take a negative rate of return than stuff their money under their mattress. They were willing to take that negative rate of return as a way of as kind of an insurance policy on their physical dollars. So that's something that I found very interesting. So if you're looking at the short-term treasuries and you're saying, oh, well, they're paying that small of a rate of return, then this is definitely the bottom. It's not going to go negative. Well, it probably won't. I don't know, but it has been in the past. Now, the last thing that we want to show before we open it up for questions, I want to show you how easy it is to actually trade this product. If you were to look at an option chain of, say, Google or IBM or whatever stock you want to look at, you would see all the calls and all the puts and how you could actually make trades on any of those products. The same holds true for these ISE options products. So right in here, for example, we see the Euro FX. This is the underlying. The way to think of this is 79.55. That's the price of the underlying right now. So, and of course, this is based on Friday's closing price. So in here, and these are the December options. And once again, this is stale information based upon Friday's close. We'll have the updated ones, obviously, on tomorrow morning when the market's open. But you can see how you have in the money, at the money, and out of the money options, just like any other option underlying. So in here, let's say that we were bullish and we wanted to just buy an at-the-money call option. One thing that we could do, let's say we wanted to buy this 79.50 call, we could click Trade, and this would take us right to our trade ticket. So by doing this, the point that I want to make right now is that it's just as easy to trade this option as it would be to do anything on any other stock or anything else. Now, let's say that we wanted to do a spread. One thing that I want to point out is a risk-reward graph. Let's say we wanted to buy this call option. I can click once for buy, and then I wanted to sell this call option and set up a bull call spread. Click twice for sell, and then we could go to what's called the trade calculator. What this does is this shows how we're buying one call and selling another call. We click calculate, and now we can see a risk reward. So let's say that you are bullish on the US dollar. You think the dollar is going to go up versus the euro. You can see on here that you have a limited risk, limited reward trade. Now, if you want to learn more about spreads, you can look at some of the OptionsXpress webinars on spreads, or I know the ISE has a lot of webinars discussing spreads, but what I think is neat about this trade is you know that, let's say that I know that no matter what I do, the most I can possibly lose is $84. I like that thought personally, the fact that I have a limited risk. Even if the US dollar plummets and it goes to zero and everything just becomes awful, Mathematically, the most I can lose is $84. Now, on the flip side, the most I can make is $116. That's my decision to make as a trader of what strike prices to select and what time frame to select. But once again, the point is this. You have the ability to set up spread trades. And by the way, this estimated commission, this would be a $13 trade, not $25.90, by the way. You have the ability to set up these trades and make them work for you to fit your current needs.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.